Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Pederson.
Thanks for joining us, Real Estate Risk Report. I'm your host, Lance Pederson. So today I have with me esteemed guest, Travis Watts. How you doing, Travis?
Lance, I'm doing great. Appreciate the invite.
Yeah, no, thanks for joining us today. So Travis is, he's been a passive investor in the space, a lot of multifamily stuff throughout the years, so he's kind of sat in that chair. He's been involved in more active roles as well. So he's got a pretty good take on, kind of being in that position where you're not necessarily the one making decisions. And so we always like to have people on that kind of can appreciate that side of it, right? And all that goes into it. So why don't you give us a little bit of introduction, how you got into real estate investing and what you're up to?
Yeah, you bet. You bet. I think that I'll start it this way. I'll try to be brief on the backstory here to the point of speaking more about multifamily and the passive side. But in the humble beginnings, I was introduced to real estate, or I should say passive income rather, through the Rich Dad series of books and the Kiyosaki stuff and the cash flow quadrant, Rich Dad Poor Dad, all that. And so that was kind of my first eye-opening. That was about in high school, give or take, when I was introduced to those books. Both my parents were very frugal, so they were very personal budget focused. So nothing in regard to investing, but everything in regard to just budgeting and using coupons and not buying things you don't need and saving and all that good stuff. So very grateful for that kind of upbringing. My introduction to getting involved with real estate was that I started to understand and recognize that I'm not going to get to my goals by just saving money or throwing things in our mattress. I'm going to have to actually get out there and invest, and that's something I had to take on myself. So I got started the way a lot of folks get started, which was single family real estate on the very, very, very active side. I did every single thing myself, all the bookwork and accounting and, management of tenants. And I got in house hacking, fix and flips, vacation rentals. I did a whole bunch in that space from 2009 through 2015. While working a very intense W-2 job in the oil industry that took almost 100 hours a week of my time, in addition to doing all of that. So quite frankly, I just burned out. 2015 was my burnout year. And I thought, there's just got to be a better way. How do the gurus do it? How do the high net worth people do it? They're not out there doing single family investing. There's got to be something more out there. That's where I had to go back to the drawing board. I had to join real estate groups, listen to podcasts like these, read a whole bunch of books. And that's where I discovered apartment syndication, passive investing, real estate private placements. And for me, that was the answer. The answer was I needed my time back. I didn't have time and energy to dedicate to this. Being active myself wasn't a good fit. I just wasn't good at it, quite frankly, nor did I like it. So that was kind of a bad combo. And so I started. So from 2015 through 2020 now, 5-6 years, I've been a full-time LP limited partner in apartment syndications. Mostly about 80% of what I do is value add, mostly B-class syndications and stuff like that. And partner with a whole bunch of firms, obviously with Ashcroft Capital, I'm affiliated with them, but many other firms as well. So yeah, I've seen a lot, I've done a lot, I've made a lot of mistakes. And I think that's kind of our topic of today.
Yeah, definitely. No, it's a good story. Yeah, you're right. I mean, it's you get into real estate and it's got all those benefits, but yeah, doing it actively, especially single family, it's a ton of work. And yeah, it's great. You had the oil and gas experience too. So that's always that's the other one, that the alternative investment that a lot of people, gravitate toward as well. So, so for you, I guess when, obviously having the benefit of, dealing with real estate in the single family sense, obviously it sort of translates nicely to multifamily and especially one can appreciate it. I suppose the fact that, invest as a passive investor into, 150 units instead of all the work you had to put into just like a single home or something. But, what is it that you found, especially now sort of, being in an investor relations capacity that when you're talking with past investors, like what's the most frequently asked question? What are you hearing the most from people as they're like, or what, I guess maybe put it a better way is like, what is their biggest concern? Like, what is the number one thing that they're like very concerned about when assessing an individual deal that they're asking you, and that you have to like, what's that objection that you're having to overcome?
Sure. Yeah. It's a great question. And I do speak with a lot of investors, both individual and through Ashcroft. And so got a nationwide scale here. But well, of course, we're in 2020, we're in December. And so COVID's been the topic of the year, right? And what impact that has had and could have and may have, plus all the government stimulus or lack thereof, and what these eviction moratoriums mean. And there's a lot of questions like that, industry specific, that that I have to stay up with constantly. But to your point on a deal, I always talk about the first mistake in my mind that I made was putting way too much emphasis on the actual deal itself and the projected returns and the possibilities, and not enough on the team and the sponsorship group. And unfortunately, a lot of the questions that I get are very, very deal specific, right? They're either underwriting questions or what do you think about the cap rates in this market and stuff. And that's all important, of course. But, a great deal in a great market with a horrible sponsor is going to be a failure. So I try my best to, coach people, if you will, on just how to view sponsors and how to write out your own criteria and how to match your philosophy and criteria with operators in the space and things like that. So always happy to answer deal questions, of course. As I said, that's important, but you've kind of got the three areas of risk: the sponsor and the market and the deal. And when I got started, and this is what I see so many folks do who are newer in the space, is reverse that upside down and think, well, the deal's the most important thing. Then I'll worry about the market. And then last, I'll take a look at the group, and it is what it is. But several stories about deals not performing due to the sponsorship group. So I would say that's, to me anyway, number one.
And maybe give us a few examples of what have you seen out there where that, how can sponsors screw it up? Obviously multifamily, it's not that hard to sell to people, right? The notion of, I think we're all over the fact that COVID aside, that people need a roof over their heads. We're becoming a nation of renters, right? It's, and especially in the workforce housing sort of sense, I can see, you can get a little more nervous in the luxury Class A stuff. And, but so that aside, what are sort of the big gaffes that you've seen sponsors make that, when it comes to, messing up a deal?
Yeah, it's a good question. And, so there's obviously things that would be in the control of a general partner. And then there's always the outside stuff. There's the hurricanes, the tornadoes, the whatnot, the unforeseen events. So what you can do, what's in your control as a limited partner, what I try to do is, I'm looking at a business model and a business plan, and it very much is a business, just like you would look at any business. If you were going to buy shares of a publicly traded company, like say an Apple, well, you're instilling trust in Tim Cook, the CEO, and all the employees to execute a business plan, and you're betting that they're going to do it. It's really no different in a syndication. You're looking at general partners kind of as CEOs and saying, do you have the experience to pull off this business plan? Do you have the track record to execute it? Have you done it before? What did those results look like? And so you're trying to match up the skill set and the competency of the team versus what the business plan is. And you're just trying to make a decision for yourself. Is this realistic? Is this going to happen? Is this very aggressive in their approach? In other words, that they're probably not going to meet these rents or these returns. Or is it something, hey, look, we've done this 40 times in a row. We got success to show for it, and we're just doing the exact same thing again. And so you have a little more confidence, perhaps, in a group or a situation like that.
Yeah. Yeah. Because it seems that it does what, from my purview outside looking in, right, is that it's become competitive, or at least a perceived competition when a multifamily syndicator is, and so the fluffing up of the pro formas and, we're going to push rents to this and, all in the name of, right, having that it's a 19.3 IRR with a 2.15 equity multiple, right? It just, you just feel that. You feel that everyone feels that pressure to sort of have to, post that. I mean, I even had a conversation this morning with one of my advisory clients. Same thing, just very, and it's justified, but very concerned about, well, how is this investment vehicle that we're creating, how does it stack up the optics of the return to this competition? Right. And legitimate, like I said, legitimate concern is like, man, but if that's what we're going to put out there, is that really marketable? Are the investors really going to want that kind of return? Right. Well, then that turns into, well, let's just delude ourselves into believing that we can generate these higher returns. Let's put it out there. And then of course they come nowhere near hitting pro forma. And it seems to me a little bit like it's almost that it's an epidemic of its own, in that's sort of what we got a lot of those deals out there that just aren't coming anywhere near hitting the, especially now with the COVID thing, I think most of them are going to fall short. But is that what you've seen a lot of too? Is just a lot of when you look at deals and deals across your desk, are you just sort of like, man, that just, I don't see how you're ever going to get there? Or am I over kind of thinking that?
Yeah, no, it's a great conversation piece, because in my experience working with a ton of different investors across the board, it seems to me that the more savvy investors who are more experienced, perhaps as an LP, are much more willing to do the 5 or 6% cash flow deal versus the potential 12% cash flow deal that's aggressively underwritten. But that also comes down to how interested you are in capital preservation versus just trying to shoot for the moon and get the highest returns you possibly can. And, that's a decision everyone's got to make for themselves, is where do you stand in the risk scale? And the more wealth, generally speaking, that you acquire, the more interested you might become in capital preservation. The game becomes not losing versus trying to win every time. And so, I think a big mistake from newer operators, especially newer GPs coming out of these training programs and boot camps or reading a book and getting inspired is, well, I have to be competitive. Why is anyone going to invest in my deal if I don't show them these fantastic numbers that are out of this world and they're better than everyone else's deal? But that is a mistake, especially with lack of track record or experience to actually execute on that. So good operators in a general sense are the classic under promise and over deliver. And a good metric to look at is just simply the past performance. If you can see the past deals they've done where they said we project a 12% IRR, but we actually achieved an 18, that's usually a good sign. That's also a sign too of market cycles and trends. But again, as an LP, you can only do what you can do, and you're trying to read between the lines to just figure out how realistic and how competent these teams are. And, to talk frankly about risk, I mean, you can lose money in just about anything. And I certainly have, and people do. And so for me, it's just, we were talking before the show about, your risk adjusted return, so you're trying to find an optimal, adequate return on investment without taking an exorbitant amount of risk. We certainly hope to have more than what you might find in a bond or a treasury or CD or putting your money in the bank, but yet, I get hit up all week long on social media by these cryptocurrency traders telling me how they make 2,000% a year or whatever, a month. I don't know what it is. It's crazy. And it's like, maybe, but you can lose your portfolio as well. So, I'm always asking them the risk questions that not very often have an answer to them. So
yeah, exactly. It's just there's no right answer. And I think when I work with my clients on like structuring things and stuff, I'm just saying, listen, whatever you do, you're actually bringing a net new investment product to the marketplace. Okay. And so to you, it's that you get to go and add value or do whatever you like. You get to buy real estate and manage it and, execute the plan. You enjoy that. You have passion for it. That's great. Right. But to that passive investor, it should be solving a problem in their own portfolio. Hence, they need, like you said, they need to know what their goals and objectives are going into it, right? And so if you're a neurosurgeon and you're just raking it in W-2 employee and have all this income, then maybe why is once again multifamily is great because you can get cash flow and a lot of that income's not necessarily hitting you, so it's pretty tax efficient, right? And at the same time though, but those guys are probably be the ones who be more likely to sort of stretch and take on more risk because they're like, why not? Right. But they're not going to do that with their entire net worth. Right. I mean, it's just, and so it's individuals, personal. Everyone has their own, they're trying to solve their own problem. So it's just own it. Right. Like if this is if this deal is, don't take a cash flowing deal and try to make it like some hyper growth, home run or, grand slam sort of deal so that you can compete because you think that's what everyone's after. It's like, it is what it is. And own it and not be afraid of that. And then the investor at the same time is that I think it's like it's a sales process, and ultimately sometimes dysfunctional buying leads to dysfunctional selling practices, right? And that kind of perpetuates itself. And it's the same thing in this. It's from an investor's perspective, to be a part of stopping that from happening, or fluffed up returns or whatever, is you got to stop acting like you won't take nothing less than a 15 IRR on a deal. Right. You need to actually say out loud, like, hey man, at the end of the day, I do need some income. I like cash flowing deals. I'm, being more clear about that. And it goes both directions of making sure that you're marketing it is for what it is. Because a lot of them do seem like it makes it look like it's cash flowing day one, but there's, like, oh, the cash and cash return year one is going to be, 10%. But then when I look at the deals that never seem to actually produce that to the investor, I mean, yeah, maybe the project did, right? But they didn't make a distribution. And so it's kind of that fine print too, of just realizing that, hey, this is it is value add. It's more of a growth investment. Yeah. In the later years, you have some cash flow. But just start with, what am I looking for? What am I trying to solve in my own portfolio? Like you seem pretty young. So my hunch is like, you're probably thinking, hey man, I like the deals that maybe are more risky. I mean, like have more risk, like growth. I mean, cause that's how, like you said, you hustle and do all this work. Well, it's when you're young, you can afford to take, more calculated risks. When you get older, right? Maybe you should kind of back off and do more core stuff.
Yeah, that's 100% it. I myself, in transparency, I'm kind of middle of the road, a combination 50-50, we'll say, of capital preservation interest / growth and opportunity, right? I can afford to take some losses if need be here and there, as I am younger and I'm not about to quote unquote retire in the traditional sense. I just wrote a blog on this about one of the guys in my network. I deem him one of my mentors. Heavy real estate guy, a lot of multifamily, full-time LP like myself, just, decades ahead. And I was shocked to learn he's got 40% of his entire portfolio, mind you, his net worth in the ballpark of maybe 80 million, give or take, in municipal bonds that are insured. And my first thought was, are you kidding me? Why would you put money in something that yields a 3% return? Well, it's a pretty safe 3% return, and it's tax-free income for him. And having that much wealth parked in a vehicle like that, even if every real estate deal folds on him, he still has a decent lifestyle built in, with that kind of portfolio. So I'm not at that point where I'm parking half, in like bonds, but I understand, and that's a conversation to be had with LPs and something to think about.
Yeah, exactly. Yeah, and I think that does prove, because you meet some people who it's shocking how much of their portfolio. I mean, like, yeah, I'm obviously super bullish on real estate, love it, right? But then you learn, like, some people, like, they're all in, like 100%. Yeah, like they're 100% of their net worth is in real estate, which, I mean, I don't know what to think of that, right? And I think that's just it, is that like your mentor, the municipal bond thing, his money's not going backwards, right? He's beaten inflation, right? It's somewhat liquid, right? Obviously, and then it's tax efficient too, because that's the beauty of muni bonds. So yeah, I mean, those are the ways to kind of think about these things going into it. And like you said, the sponsor is a big part to play. And sometimes I think it's, looking past I mean, if they're a good sponsor, they're probably also good at marketing and they've got a good brand and those things. But looking beyond the shiny, the shiny exterior, right, into like, what are these people all about? And then once again, not to say that some emerging sponsor is bad either, right? It's just, but my take is that you should just be earning a risk premium for investing in someone with less experience, right? I mean, like that's That's how you have to look at it, is that it can't be emotional. Like it's got to be, okay, seems like these guys have got good access to deals. Seems like they know what they're doing, but at the end of the day, limited experience. Yeah. I expect to get a little bit more of the upside on the deal because I'm taking more risk. How about other property types? I mean, do you exclusively multifamily? Have you gotten into self-storage or mobile home parks or anything else?
I have not yet on mobile home parks. So it's probably my next investment. In fact, I've been betting that about 3 to 6 months at this point. But I've invested self-storage, first lien notes, various cash flow funds, publicly traded stuff to an extent, some REITs, some high dividend paying, stocks, things like that. I'm not a black and white thinker. It's not just one thing's right and the other's wrong. It's sometimes a combination. Generally speaking, what my philosophy is invest mostly. I don't know what percentage to give you. I'm not a financial advisor or planner, but invest mostly in what you know and understand and what makes sense. And to me, to add on to that, it's what is necessary, what's essential. If we're going into a big depression or a recession, perhaps, are people going to need affordable housing or a share of a stock, in the market? I don't know. It depends, but I'd rather have housing and water and oil and gas and energy. So that's where I tend to focus, my investments that way.
Yeah, I mean, that's kind of what Warren Buffett says too, right? Like it's like he invests in what he knows, and I think that is at the heart of it. Like it's easy to always quote Warren Buffett because he's great and wonderful. But I think that the simplicity of it is to say, use your common sense, think through what do you understand. If it doesn't make sense and you can't sort of envision how that works out. And that goes with the plans, the value add plan too. It's just stop and think through it. Like, okay, what are they doing? So they're going to put $15,000 into every unit, and that's going to get them this, and they're going to do that. And then people be willing to, because they put in laundry, they put in washer and dryer, they'll be willing to pay $50 more. Okay. That seems reasonable, because when you work backwards, that's what the sponsor was thinking. Right. And I think sometimes they overlook those sorts of things. Like, okay, well, if I was in that, would I want to live in an apartment in the middle of the nowhere? Well, I wouldn't. Who else would? And why would they want to live there? Hence the market, right? But it's just thinking through what do you know and investing in the things that you have conviction in and understand. So in terms of, you've been in the business quite a while now. I mean, have you seen any, implosions or really things that went completely sideways that you've sort of observed from afar, or maybe even things that you invested in? Any juicy stories?
I guess to piggyback off what we just talked about. So there was a point around 2016, give or take, as I was making that transition from single family to multifamily and changing up my strategy, that I got a little bit concerned about diversification and about being in one asset class. And so as I was striving away from that a little bit, I was joining investor meetup groups, and I was hearing about venture capital and seed capital and distressed debt investing and all kinds of these crazy things I've never heard of before at the time. And I did pull the trigger on a couple different funds through an investor group that they were doing some distressed debt investing. It was a new concept to them. Again, sponsor, right? This is a mistake I made. I didn't vet properly the track record and the sponsor's experience. I like the individuals a lot. It made sense to me at a certain level to be able to pull the trigger as an investor, but ultimately, in hindsight, looking back, it didn't make complete sense to me because I didn't understand this fund structure and how many third parties were involved and how many times capital had to change hands and go through here to this person, to that, to this, to that, just to get a deliverable. And long story short, there was a lot of partners in this fund that I wasn't aware of. And the folks that I vetted somewhat, they weren't a problem. They actually did their job and did what they thought was right. They parked a lot of their own personal capital and net worth into these funds. So not blaming them at all, but there was a third party operator in a different state that I wasn't aware of that ended up being a Ponzi scheme. And so being that this was a fund structure with numerous partners, they comprised roughly 35% of this overall fund, and money went like that to zero overnight, and that was it was a scary thing, and it was a wake up call. And again, it's like back to the basics, how necessary and essential was this in the first place to even do? And I parked a little extra capital into it because of these shiny projected returns. It was looking like it was going to be a 20% annualized return. And I'm thinking, hey, it's better than what I'm getting in a lot of real estate deals. So, I'm going to go a little heavy on this one, and lost a lot of money.
Yeah.
So, to say the least.
Yeah, no, it's, being fund administrators ourselves, right. And administering these vehicles, it's, they get complex really quick. Like the second you start having more than one asset, and you've got all these entities all over the place, and servicers, and, man, even for us, we're in the business, we've been doing it for 7 years. Just tracing everything through, to make sure everything is legit, which is what I'm passionate. That's my passion, right? It's this notion of oversight is important, right? You need some independent party that sort of its job it is to make sure that those things, are all tying together, because it is when it gets complicated, and complexity is one of the main things that, bad people use, because we all are, if we don't want to admit it, but we're all a little bit insecure, right? Especially when it comes to things we don't know, which is why I do this podcast too. Cause I'm like, I know a lot of real estate guys speak lingo, and it's like, you can't even understand them as an outsider. And I used to be an outsider, and I was like, oh my gosh, it sounds like you're speaking a different language. So it's just trying to help simplify things and help people kind of understand them. But when you run into stuff that seems too complicated and you feel like you don't understand, it goes back to what you're saying. You just gotta walk away, right? Because if you can't understand it, you got to just have enough faith in yourself that you're smart enough and you should be able to understand it. And if someone's doing double talk and making it sound like they're doing all this crazy stuff, it usually means that they're hiding something, or something's not quite sort of above board. So.
Sure. And even outside the fraud stuff, there was a period of my life where I worked for a large brokerage firm, and it was complex for me to explain to investors the inner workings of just mutual funds, and whatnot. It's not an easy thing, and there's a lot of fine print, and there's a lot of changing hands and different types of management. There's a lot that you just won't know. Whether it be through a big major, listed company or a mutual fund. And that's not a fraudulent thing. It's just complex. And so that's what I love so much about real estate. It doesn't matter what asset class of real estate that we're talking about. It's like, hey man, there's an apartment, building and the rent is $1,000 a month. Do you think someone might want that? Like, of course, it makes sense.
I can go touch it. I totally agree. And that's why I like it too. There's only so much dirt. Right. The people need to put a roof over their head. They need to operate out of buildings like that. That stuff just makes sense. Right. Some of these complex derivatives. And once again, it's not like everything that's complex is a fraud. It's just saying like, it's for certain people. And if you can hang and you enjoy complex things and being highly intellectual and all that, like, great, go for it. But if you don't, and you want to play golf or you want to go on vacation and you want to that's what passive investing is. If it suddenly becomes a second job, then you got to ask yourself, am I being compensated enough for this, extra job of trying to understand my own investments? So,
yeah,
cool.
Yeah, that has one quick thing on that reminds me of something I talk about a lot, time value. And it's interesting because I calculated at one point how much time I had put into the single family home. I think this was a flip that I was doing. And more or less at the end of the day, what it came down to was about $50 an hour is what I was making as, manager of this project. And thinking back to, that was in my early 20s, that was worth it to me. $20, $50 an hour. Like that was kind of my range. You know what I mean? So that was every bit worth my time. But today that's not worth my time. I'm not going to go do something for $50 an hour and take that kind of risk in order to get that potential return. So that's something, as you pointed out earlier, a lot of investors in the passive space, LPs, are doctor, dentist, lawyer, attorney, business owner, pro athlete. They're folks that are making more than $50 an hour. And so maybe it's not in their best interest to be active with everything. So, but
that's right. Yeah. And that's the beauty of it. It's like, you want to make the investment, you understand it, you feel safe about it. It's making money while you sleep. and someone else is doing all the hard work. Right. And that's why I always defend the sponsor side too, is to say like,
Sure.
it's most of these strategies to execute them. They're a lot of work. It's really hard to find an asset worth buying. It's really hard to execute especially like a value add strategy and turn it around and put tenants in and deal with subcontractors. And, it's so, I think that, and not to mention that most of the compensation is deferred. So they're not really getting much along the way. So beating them up over their, 100 basis point asset management fee and, like just trying to like cram them down on every little thing. It's sort of like the way I look at it is like $1 billion private equity, fund, like a leverage buyout, getting 1.5 or 2%. Yeah, it seems a bit excessive. I'm just like, maybe I don't fully understand it, but I'm going, a multifamily syndicator, and you're getting all worked up over a 2% acquisition fee or something. It's like they got to feed themselves and their family too.
Yep, 100%.
So. Cool. Well, it's been great catching up. I love hearing the stories, and thanks for sharing them. And it's always good to sort of hear from the passive investor's perspective, someone who, kind of said, hey, it's too much work. There's another way. And for me too, obviously I do believe the same. You got to start with the sponsor. These are people. That's what you're investing in. I always tell everyone it's the transaction. The true transaction is one of trust, right? I mean, like that's what you have to earn first. If you're looking to raise money from someone, you're going to have to earn their trust first, because it's their money, right? It's and if you can do that first, then you can, maybe expect to, have them allocate some capital into an investment should it, solve one of their problems. Right. But yeah, it's good stuff. So, well, thanks again for joining us, and probably have you on again to chat about, other stories and things as you run across them. So,
sure. Sounds great. Thanks
so much, man. Yeah. Take care, Travis.